In our strategy, we don't trade headlines. We track signals, sequences, and phase pressure. Today is about a growing divergence we've seen before. Markets are at or near highs, but housing and labor data are weakening. That tension matters more than the index level. We're reviewing Talks and their breakdown of housing starts and jobs data. They focus heavily on the raw economic numbers. Our role is to map that into our strategy framework. Housing starts are at their weakest level in years. Builders are pulling back despite slightly lower mortgage rates. That's a demand and affordability signal, not a confidence signal. Housing transmits early, construction slows first, then jobs, income, and consumption follow. Homebuilder sentiment remains below expansion levels. That tells us this isn't just noise, it's ongoing pressure. Job growth undershot expectations. Prior months were revised lower. That matters more than the headline unemployment rate. Downward revisions are a trend signal. They tell us prior strength was overstated. This is typical late cycle behavior. Slower hiring reduces income growth. That pressures consumption. Earnings follow with a lag. Yet markets keep rising. Why? Because weak data increases rate cut expectations. Markets are trading policy anticipation, not current economic strength. That works, until it doesn't. In our strategy, this reinforces late phase 1 into phase 2 pressure, not a crash call, but rising fragility. Risk management matters more. Exit discipline tightens. Participation becomes more conditional. This does not force an all-out risk exit. It does not invalidate ongoing melt-up participation, but it raises sensitivity to policy disappointment. Quick note, this is educational macro analysis, not financial advice. Markets expect continued cuts. If that path changes, repricing can be fast. That's the risk window. Housing starts and permits, payroll revisions, short-term yields and rate expectations. We don't guess dates. We track confirmation. Sequence always matters more than speed. Weak housing and labor don't break markets immediately. They quietly compress the cycle. That's how late phases begin. We don't need to be early. We just can't afford to be late.